NVIDIA is down 9% on Thursday. This is big, but this is a great learning lesson for people out there who've been watching our channel and people who've been a little worried and that you're missing out on major hype. Let's look at NVIDIA using our software, and I'll explain further. So I'm pulling up NVIDIA with our exclusive software. It's down 9%, and I want to show you the last year. Look at this, 52-week high of 346. Now, if you're new to our channel, go look at our past videos on NVIDIA. You can search for them, and you can see all the comments below about people saying, you don't get it, you're an idiot. And I was like, listen, I just don't see the value. I'm Paul, I'm a value investor. My goal is to find where price and value are disconnected, but when the price is lower than value. That is my goal. Now, that's easier said than done, but I don't make egregious assumptions about the future. I want to show you something about NVIDIA. Look at this news. NVIDIA says US order restricts sales of AI chips to China, drops because of exports. NVIDIA falls 7%. This is my point, guys. This is why you have to be conservative in your assumptions about the future, because so many things can happen. This can happen like that. I prefer to make conservative assumptions about the future and buy when the price is below those conservative assumptions. Does that mean I'm going to be right? No. But if I apply that to all 10,000 stocks that I can see, I will find 20 to 40 where there is a disconnect between price and value. That is my sole goal completely. NVIDIA is the prime example. This stock was $3.45 per share just 9-10 months ago. It is now $130 some a share. Okay, so what's NVIDIA worth? Well, let's go look at its income statement real quick. Because oh wow, look at this. So the other thing is this. Revenue's coming along, going great, big jumps, whoa. And I said in other videos about chips, is this sustainable? I don't know. I have no idea. Let's go look at the profit. Is this sustainable? Tripling profit in 2 years. Is that sustainable? That's where I sit there and say, I don't buy into that mantra. Okay. So let's go look at analyst estimates. Even analysts are looking at a big drop in the next year of earnings, 25%, but it'll start rebounding again and go back up. Okay. That's about over doubling in the next 5 years, which is still great. Look at revenue. Revenue slows down, growth slows down considerably, but it's still good revenue. So your job will be to put it into our stock analyzer tool, evaluate the company, and determine what price to pay. These are the 8 pillars right here. Now, here's where my concern comes, guys. The 5-year PE is 68. The 5-year price to free cash flow is 71. Now, obviously, in the last 5 years, they had a lot lower profit years. If they repeat last year over and over and over again, these numbers are going to be drastically lower. But they're also issuing shares, which I don't blame them for since the stock is expensive. They're issuing shares. And what's that doing? It's diluting you as an investor. This is a very unknown thing. When companies issue shares, let's say a company has 10 shares outstanding and you own 1. You own 10% of the business. Easy enough, right? Well, what if they want to raise capital and instead of taking on debt, they issue 2 more shares? Now the company has 12 shares outstanding. You still own 1. You now own only 8.33% of the business. Now you might sit there and say, well, big deal. It's only 5.8%. Listen, there are companies out there with 2,000% increases and nobody pays attention. But it's you to be an astute investor and realize this is a little bit different here. So what do we do with all this information? Well, like I said, the future is unknown. Investing is an art. Because we don't know the future, all we can do is make assumptions about the future. So we created all of this software, especially the stock analyzer tool. This is all used as a way of screening out companies based on their numbers. If we put all of our assumptions in the stock analyzer tool, it's going to give me prices for the company that I want to pay based on low, middle, and high. If the stock is currently selling below those prices, my next job is to do more homework. What does that involve? Googling people's ideas. Googling what analysts think. Go read the bear story and the bull story. What are people saying for and against the company? Go understand those things. But most importantly, this community. We created this specifically for the community. There are thousands of value investors in here that talk every day about their ideas. Research is hard when it's done alone. But when it's done with a community of people, and I guarantee you there's lots of people here who research NVIDIA, they're in there talking about it. So why do research alone? Go do research with other people. And all the software, including all these tools up here, including our watch list, our exclusive content, and everything here on your mobile phone is available for less than 1 cup of coffee per day. Go to everythingmoney.com if you're interested in it and check it out. And we're going to do a stock analyzer tool right now. And my big thing is, guys, please rewatch it. Because I want you to really understand. I'm going to go slowly through this and explain every single line and why I'm doing things. Rewatch it over and over. It's very important to understand our process. So first off, I can choose between 1 and 10 years. I always automatically choose 10 years. Number of assumptions, I pick 3. You can do 1 or 2. So first line, revenue growth. Now, guys, they had big surge in the last 10 years. And a lot of times on companies, I'll look over the last 10 years to see what's going on. But as we saw for the analyst estimates, they don't expect the same growth to happen, which makes perfect sense. They were looking at low double-digit growth. So I tend to put the analyst estimates on the high side. Middle side, let's go with 8. And low side, let's go with 4. So 4, 8, and 12. Now, profit margin. Even though their growth was so big, I like the fact their profit margin stayed the same. Some people would be against it. Same with free cash flow. It stayed pretty consistent. So what am I going to do here? Well, they might have to, I'm still going to assume some lower profit margin because during boom times, profit margins tend to be higher. So I want to pull it back a little bit because I do believe we're at the end of a major bull and, economic growth worldwide. So I'm going to go with 24, 27, and 30. I'm going to do the same thing for free cash flow. Now for PE, even though the 5-year numbers are high, these 1-year numbers are still very, very high, even with the recent work. I believe PE should be high for 2 reasons. 1, growth rate. 2, moat. NVIDIA has a really great, I do think they are the dominant player in the graphics industry in terms of all these video graphics, things like that. So that is a good thing. But where's their growth? I mean, 12% is good growth, but is it justifying 35 or 45 times earnings and cash flow? I would question that. All right, so I'm going to put in 13, 15, and 17. Might sound conservative, but again, my goal is to be conservative. And the great news is, if you have the software, make your own assumptions. It's all just math. At the end of the day, when you buy a stock, you're buying a business. And just like you buy a business that's not on the stock exchange, your return is going to be based on the cash flow it pays off. And with these companies, even though you don't get the cash flow directly that day, you're making the balance sheet better, and they might do a one-time dividend, or they're going to buy back shares, and you're going to get a bigger piece of the company as time goes on. So in terms of desired annual return, I'm actually going to go a little bit low here, 12.5%, 15, and 17.5%. So why do I pick these numbers? You can get 9 or 10% by buying a low-cost ETF and matching the market. So in order to buy an individual company with margin of safety, pick a higher number. Since I'm making more conservative assumptions here, I'll pick a lower desired return because I've already beaten it up here. And the lower the return, the higher the price I'm willing to pay. Middle assumptions, 15%. Because it's in the middle, I want a little more margin. And the final one, the high assumptions, I want a higher margin of safety on there because it's less likely to happen. I hit the analyze button. The stock is currently at 138. And this makes sense. 35 is the low, 64 is the high, 50 is the middle. And before you go out there saying, that's not going to happen, if you'd watched my videos 9 months ago, people were saying stock isn't going to fall that much. So if you like this video, I encourage you to do 2 things for me. 1, subscribe to this channel. And 2, watch our next video about margin safety and how you can use it in your portfolio. Thank you very much, guys.